Catherine McQueen and welcome to IP Go, the show where we take a look at the IPO world, past, present and future. Today we're going to break with convention and cover a failed IPO. This has been such a big story that there is no way we could ignore it. Once billed to be the IPO of the year, WeWork has become synonymous with everything that's wrong with the current IPO market. Overvalued, questionable accounting, mythical tech and bizarre corporate governance. This story has it all. Strap yourself in and get ready. The We company, parent to WeWork, was recently forced to scrap its IPO following an unexpected backlash from investors and analysts on Wall Street over its governance, payments made to co-founder and chief executive Adam Neumann, and its use of a complicated corporate structure. Also, the fact that the company has seen its cash burn grow just as fast as its revenue has hardly inspired confidence. The company, which claims to want to elevate the world's consciousness via the medium of communal office space, was looking to raise between $3 and $4 billion from the float. But pressure became so extreme that CEO Adam Neumann was forced out of his role. He has since blamed public scrutiny that he said distracted him from doing his job. Furthermore, WeWork looks set for a liquidity crisis as it will lose access to a $6 billion loan from a group of banks including JP Chase and Goldman Sachs that was contingent on the IPO raising at least $3 billion in new investment. Bloomberg is now reporting that according to two sources close to the company, it could run out of money by the end of November if new financing is not sourced. Major WeWork backer, SoftBank Group CEO Masayoshi Son has recently said that he is embarrassed and flustered by his track record after the valuations of WeWork. So this all sounds very dramatic. Let's try and work back how we got to this point. At its crux, WeWork is an entity that takes out long-term leases on commercial property while selling short-term leases to its tenants. From the off, this is a highly questionable model. An additional complexity is that in some cases, the property it leases is owned by its former CEO and affiliates. Its low-cost and flexible contracts for tenants has put pressure on other office space suppliers, so it feels like a reasonable assumption to view the company's strategy as an attempt to price out the market and gain market share. It's an ambitious pitch, but in a space as unglamorous as office space, how has it managed to raise so much capital and buzz about itself? The answer may lie in its valuation. Despite being an office space provider, the company has pitched itself as a tech play, repeatedly citing proprietary tech in its IPO prospectus without ever disclosing how this tech has been applied to the rental of office space. By gaining access to high valuations, it has been able to raise funds in excess of what might be normal for office space rental businesses, and as a result has been able to expand globally despite consistently negative returns. Going vegan was a great headline catcher for the firm, cementing its woke credentials and deflecting away from the unorthodox corporate governance at the heart of the firm. However, when Adam Neumann sold up to $700 million ahead of filing for the IPO, a mass collective of eyebrows were raised, leading to more red flags than a communist parade. The rest, they say, is history. So where does the company go from here? Scrutiny will doubtless fall on SoftBank for its perplexing investment in WeWork. We can probably expect some scrutiny on the accounting practices and also its corporate structure, which has dumbfounded critics. The latest reports from the Wall Street Journal suggest that SoftBank is putting together a proposal to rescue the firm ahead of its imminent collapse. Whether or not this is just chucking good money after bad remains to be seen, but rest assured that we will be watching closely. See you next time.